Hello everyone, this is Professor Kent and today's recording is to go through some of the questions at the back of the chapter 3, and in that chapter what we're going to do is we're going to do the first problem. In this first problem we're going to be learning about business combinations. So that's what the chapter was, business combination. Before we even go through the question, what we needed to do is we needed to read the required. So the required is to prepare the journal entry for Legman Limited and in Macallan Company to record the transaction. So there's two companies, one is Legman and the other one is Macallan. So let's read the question. This is the balance sheet of both Lanigan and Macallan. So these are the two companies. They're going going into a business combination, and we wanted to know what are they planning to do. On December 31st, year 2, Lanigan purchased all. So Lanigan purchased all Macallan's assets and assume all the liability for $250,000 cash. So what Lanigan did is Lanigan paid $250,000 to purchase their assets and their assets and their liabilities. So that's what they did. They took their assets and they took their liability and they paid $250,000 for that. So let's see what journal entry we have to do under both companies. So the one company is buying, the other company is selling. So we have one is acquire, the other one acquiring from another one. One is a purchaser, one is a seller. So Lanigan, what did they do? They purchase. If they purchase it, they paid cash. So their cash will be, they paid $250,000. So one person is paying, the other person will be receiving cash. So that's the first thing they are going to do. So when you look at the assets, the normal balance in the asset account is a debit balance. The normal balance in the liability is a credit balance. So Lanigan is going to own what they have. So first thing they're going to be owning is their cash and their accounts receivable. Lanigan will take over. We have a cash and receivable. The amount is $155,000. Then they got their inventory. Then they have to put it in their books, $110,000. They also got their building and equipment, and that is $200,000. So that's, we got rid of those ones. Then we also took over their liability. Normal balance in the liability is a credit balance. We took over their current liability, and then we're going to credit their liability that we're taking over. So current liabilities will be credited. It was $85,000, and then we have to take their long-term debt, and that is $130,000. And we already paid, we're paying them cash of $250,000. And then the other thing we have to look at is the carrying amount of the assets and liability are equal to fair value. When Lanigan gets the asset, they will record the asset at a fair value. So that's something you needed to look at it. In this case, the fair value and the book value of the assets are same, or we say carrying amount of your asset and carrying amount of your liability are same as a fair value. If they're not same, then you have to take the fair value of the assets and the fair value of your liability. So this was the transaction they would do at Lanigan. Since Lanigan purchased Macallan's assets, so there is not, so they will not have any, assets. So we took over their 155, but we gave them 250,000. there's nothing in their liability, so there will be nothing in their liability accounts. So let's see how the journal entry will be recorded. So if there's nothing left here, so we needed to take them out of their books and then put them into the Lanigan books. We already put it in the Lanigan books. Now we're ready to put it in, take it out of Macklyn's book, take it out of the Macklyn's books. So we know we have to do the opposite. Assets, we have to now, when we're thinking of a Macklyn, if you have to take it out, to make it zero balance, you have to credit it. In order to make a zero balance, you have to debit it. So now let's look at it. My first one is my current liability. I needed, in accounting we learned the debit goes first, then the credit. So we have a debit of current liabilities, that is 85,000. We have a debit of long-term debt, and that is your 130,000. And then what we're going to do is we are going to credit the cash and accounts receivable that we took over from them. That was your 155,000. We took over, they took over their inventory. If they took over, we have to credit the 110,000. We also have to credit the building and equipment. And that is 210,000. If you add up all your debits, if you add up all your credits, your entry should your entry should balance. So in other words, one person's debit, one company's debit, the other company's is a credit. Now what we're doing is they're asking prepare balance sheet for Lanigan and Macklyn on the on the date that we purchased the 100% of that company. So let's go to part B, and then we will do our balance sheet under both my Lanigans and for my. So we're going to do B, and B is asking you to do a balance sheet. So we are preparing a balance sheet for Lanigan and Macklyn. So let's do first one. On the balance sheet we have asset, liabilities and equity. Under the asset we have, what do we have? We have cash and accounts receivable. So what we have is Lanigan had 602, that's their own assets, and they also their assets are increased when we did the journal entry, and that journal entry will be, if I were to think about it, we will have the money that we will have is 602. And what we are doing is, if you do debit and credit, you will know what's happening. So what I'm going to do is I am going to add my 155,000, and we are going to subtract your 250,000, and that's what's happening in your cash. So we have a total of 507,000. That's what's happening. So we're gonna do the Lanigan first, that balance sheet, and then we're gonna go do the other one. So when we have an inventory, our inventory value was 210,000. The value increased by 110,000. If it increased by 110,000, the value of our inventory will be 320,000. Going next to my building and equipment. The value of our building in our books was 320,000. We took over in building and equipment from there, Macklyn's company, so that is your 200,000. If I add both numbers, the value of your building and equipment will be 520,000. So those are my we call them total assets. So we have total assets, and the value of your total asset will be 1,300,000 So that's the value. So let's do my liabilities and equity. So let's do my liabilities. My current liabilities, in this case my current liability was 192,000. I'm gonna add the liability we took over from them, which is your 85,000, and then if I add both numbers, my liability will be sorry, I put it at the wrong spot. 192,000 plus the 85,000, the value of that will be 277,000. So that is my my liability. So let's go further. My long-term debt. So my long-term debt I have was 350,000. So what I'm going to do is I'm going to take my 350,000. I'm going to add the debt that we took over from the other company. If I add both of them together, I will get 480,000. The common shares, I'm not going to take over their common shares. I only have my common shares. My company's common share was 200,000. Then I will have my retained earning. My retained earning is 390. So my retained earnings, I did not take over theirs. We cannot take over theirs. My retained earning is 390,000. If I add my liabilities and equity, it will be worth 1,347,000. That is my total liabilities and my equity. So that is 1347000. So now this is from the Lanigans. Now we're going to go to Macallan and we're going to do a balance sheet in their books. So what we did is we took over their cash, but we gave them some cash. So we have a cash and accounts receivable. What we did is their accounts receivable was 155,000. We needed to take out their cash because we credited. We gonna add the 250,000. The value of your cash will be 250,000 for the Macallan's books. They have no inventory because the other company took over. They have no building because Lanigan took over. They have no liability. The Lanigan took over. They have no long-term debt, but they do still have. So they have assets. Their total assets will be the 250,000. Their liabilities are zero, but they do have common shares and retained earnings. So they still have that in their books. The common shares and retained earning. The value of those is 110,000 and 140. So I'm going to put 110 here and 140,000. If I add my liabilities and my equity, which is worth 250,000, my total assets are worth 250,000. So what happens? My Macallan's balance sheet also balanced at this point. So I'm going to continue doing the questions, and then some questions are different and some questions may not be different. So now we needed to do problem number 3.2. So let's see what the question is asking. It's similar question to what we just finished. I'm going to do this question and then we're going to do another recording we're going to do another recording for the other questions. So let's look at it. Now we have, what we're going to do is we wanted to know what happens. Did we take control over that company or we did not take over the control? So what we are doing is, in this question is similar but not same. So what happened to this when we purchase the common shares of the other company? In this case, in the first question, what we did is we took over their assets and liabilities. That's what we did. We took over their asset and we took over their liability. Now this question is different. What we're doing is we are taking over 100% of their common shares. So we're investing into that company. So when you do a journal entry, your journal entry will be different here. So my first journal entry will be we're recording it under the books of Rodrigues and Vancouver. So my first company is Rod, and then we are gonna do in the company of Vancouver company. So what they did is we took over their 100% of their common shares in cash, and the value of that is 230,000. So what we're going to do is we are going to record an entry. This will be called investment in Vancouver, and that is 230,000, and this is my debit, and I will have to credit. We paid cash, and that will be 230,000. Now going into to Vancouver's books, they will have no journal entry here. So there will be no journal entry in the Vancouver's books because the transaction was with the shareholders of Vancouver. So what they have is they have the shareholders. This transaction was with their shareholders. So that's the transaction was with their shareholders. So there will be no journal entry. So there will be no journal entry in their books. Now the entry B, not the entry B. B is asking us to do a balance sheet, and then we also have to do a consolidated balance sheet because we took over 100% of the other one. So let's do the balance sheet first, and we are going to do the balance sheet under both. They are asking us to do both companies after recording the transaction. So let's do the balance sheet. In this case, this is the balance sheet of EZ. So what happens is we have cash and accounts receivable, and when you do that, the value of our cash was 301. We paid cash 230,000. We invested in Vancouver. The value of the cash will be difference between the both amounts, and that should be 71,000. The inventory is whatever is our inventory, that is 105. We have a property, plant and equipment, and it is 160,000. And then what we have is we have another asset from this journal entry. It's an asset, and it is an investment in Vancouver. That is 230,000. If I add all my assets, the value of your asset will be 566,000, which is a similar. We're taking it out of the cash and we're adding in another asset. So when you go to your current liability, we have a 96,000. I have a long-term debt, and that is 175,000. I'm using short term, but I'm saying it as we go. Common shares, the value of the common share was 100,000. The value of my retained earning, and that is 195,000. If I add all those, the value of my equity and my liability is 560,000. They both balance. But when we go to the other side, I'm going to change the ink so that you will see what's happening. So we have a Vancouver, and we needed to do their balance sheet. First one is their cash and accounts receivable, and then when you do that, it will be 55,000. They didn't pay out anything because there was no journal entry in the books. We dealt with the shareholders. So the next one is your inventory. Their inventory will be 140,000. We have property, plant and equipment, 270,000. When we have, they don't have any investment, so the value of the common share will be in this case will be 465,000. So that's what we did. Then we're gonna go to the for the current liability. The current liability was 110,000. Their long-term debt will be 125,000. The common share will be, they have to keep it same, will be 150, and the retained earning will be 80,000. So they will keep their bookkeeping, but at the end Rodrigo has to do a consolidation statements. So let's do that, and if I add everything, that will be 465. But what we have to do is we needed to do a consolidation balance sheet for Rodrigo. So let's do that. This is my part C. Now I am going to do a consolidation balance sheet. The consolidation balance sheet will be UEZ. I have to do my cash and accounts receivable. When you do that, we needed to cash and accounts receivable, we have to put it together. Now I have an extra zero here. The our share was, our cash was 71,000. There, since we took over 100%, we have a control, so that's a consolidation, and that will be 126,000. I will go to my inventory. Our inventory is 105,000. We're consolidating it. Their inventory is 140. If I add them together, that is 245,000. We have property, plant and equipment. It was 160,000, and I will have to add there, that will be 270, and that will be your if I add them together, this will be 430,000. Then I go to my current liability. My current liability is 96 plus the 110, and that will be 206,000. And then going further, I have a long-term debt. My long-term debt is 175 plus the 125 gives you 300,000. Then going further, what we have is we have a common share. We have our own common shares, which is your 100,000. We don't take over theirs, and we have a retained earning, and that is 195,000. So if I add everything, I needed to balance at the end. If I add up all together, it will be 801. If I add up everything, that is 801. You notice that we don't put it in because we have a consolidation. So one company has an investment. So what happens is that we dealt with the shareholders. We bought their voting rights. So that's what we did. We bought their voting rights. So this was a question was different from the first question. First one was we bought the asset. The second one, we bought their common shares. We showed you how to do journal entries. So I'm going to do another recording to record a different type of a questions. We're going to do another recording to do 3 and 4, and then I will try to do as many questions as possible so you understand the material, what was learned in the chapter. Thank you so much for watching me. Thank you for replying, liking my video, and thank you for messaging me. It helps me to when you critique my work, or you message me underneath the video, so that I know what you are looking for. If there's anything you want me to record, please don't hesitate to message under the videos. Thank you so much, and take care, and bye for now.